Hi, I'm Peter Rose, founder of Longwood Currency Trading. The title of the video is Big Forex Risk for Small Gain. There should be some qualifiers around that. Is a big Forex risk for a small gain worth it? Do you take a big Forex risk indiscriminately? What happens when you only get a small gain when you take a big Forex risk? This is upside down asymmetric trading. Asymmetric means one side is inordinately larger than the other. And when traders are talking about asymmetric trading, what they're always talking about is taking small risks and getting enormous gains from it. Nobody ever talks about the other side of it, which is taking a very large risk for a small gain. But there's a mathematical logic behind taking a big risk for a small gain. It all has to do with, well, it has to do with your skill. If you have, I don't know, less than 3 years and 1,000 or 2,000 trades under your belt, you're probably not going to be able to withstand this kind of thing. I just did this today. That's why I wanted to chat. I wanted to chat with you about this, because I get these comments all the time from traders who are trying to do the asymmetric trading to the upside, but they don't understand the risk management that goes behind that. So they're more afraid of the loss than they are of the gain. They just have a greedy gain, but they're fearful. And they hear about all this, well, take the short stops. You know, when I'm working with my students in the fast track course, I don't teach this stuff. This comes with advanced solutions, and it's only after the student has been able to make certain guideposts or goals in their trading that I'd even present the advanced solutions course to them. Because part of trading is loss. Now, just as the yin and yang of trading itself is, there's losses and there's gains, and you try to balance the gains and the losses, but you can become a quantum level on that and talk about losses. You can have big losses and you can have small losses, so that you can then even take the big loss and quantify that as a really big loss or just a big loss. It's fractal. And it follows the yin and yang. It follows Einstein's principles of mass and energy, which is yin and yang at a macroscopic and a quantum level. What he said was, you can't have all mass and no energy. You can't have all energy and no mass. There has to be a balance between those things. You can't have all cold and no hot. You can't have all hot and no cold. There has to be a balance between that. So when we're looking at the physics of the world around us, in physics, I have a bachelor's degree in physics, almost a minor in math. And so I can talk about this stuff, but from a broad sense of the view. When we talk about yin-yang in a physical representation level, we talk in terms of probabilities. So when we're teaching trading, or when we're talking about trading, say, well, I have a really high probability in looking at this current price action that the price will continue to go up, and it has enough momentum and all that stuff in order to continue to go up, and so I'm going to enter the trade. From a probabilistic standpoint, there's no person on the Forex market field throwing a flag and going, okay, it's okay, take your trade. It's a probability. You have a probability. Nothing's 100%. There's no 100% guarantee that that trade is going to continue to go up, no matter how good the conditions are from a probabilistic standpoint, because it's a probability. And so when you're looking at asymmetric trading, the way that you take advantage of asymmetric trading in the manner in which it's intended to be taken is that you trade on what I call baseline. you don't take too much risk and you don't take too much profit. You try to for a certain number of pips a day. You don't try for 40 pips a day every day. You try for 3 pips or 5 pips, and you lock that so that from a probabilistic standpoint, you're 80% probability that you have the skill to get 5 pips every day, or average 5 pips every day. So that's good. Five pips a day over the 200 trading days that's out there. You do the math and figure out what kind of a yearly gain you can get from just 5 pips. Well, Peter, if it's so easy, why doesn't everybody succeed? They don't succeed because they don't have good risk management, and they tend to take bigger risks. They let the price go too far against them for what they're thinking is their normal trading. They're just hoping that the trade is going to turn around and go back up. What the fucking, you did a trade and you're letting the thing run negative against you, and your trade was for the 5 pips or 10 pips that you're capable of gaining, and it didn't go there. So you're taking an asymmetric loss with a 10 pip probability of gain. That doesn't make much sense, because in that particular type of situation that we're talking about, we can categorically say that that's a stupid move to make. There was a economic indicator released today. One of them was housing starts, which is fairly big in this particular time, in particular in the United States, where mid-January of 2026, where real estate is undergoing a lot of volatility, unemployment, employment, housing starts, all the major indicators are banging into each other, and there's very conflicting signals. And so we expected when these housing start numbers would come out that there'd be some kick on the price, okay? So I was in there setting a couple of stops. The price went against me. I'm in there a little before the trade. The price went against me, and so I took a 3 pip loss. I just got out. It just wasn't doing what I wanted it to do, because I felt that I had the direction established that the price was going to go in. So it came back, the price went against me, and I thought there was a high probability that the price was going to go down, and that going down price would be dramatic. And so I set an observational point for about 10 pips. I think it was 12 pips. And I figured that the violence of the position, whether it would ultimately go down or not and just settle up in the high side, it would come down 10 pips anyway, because there'd be enough jump to that, where boom, it would go. Guess what happened? Just as we were going into the opening, we were 1 minute away from the opening, and I'm looking at things and the way the price is moving. I'm going, I better get out of this short limit order that I've got here, because this thing isn't behaving quite as correctly. This 1 minute before the number was to come out, price was not really doing what it should do based on my experience. As I went to hit the button to close the limit order for a short trade, the price went down and grabbed my order. And it went 3 pips in that direction. The numbers came out, and in about 5 seconds, price went 3% against me. 3% loss. Well, Peter, where did you get out? I didn't get out, because it was such a violent reaction in what I considered to be not the real direction that I said, I'm going to let this thing float because I think it's going to come back. Not only do I think it's going to come back, but I think it's going to come back in a big way eventually. So I reset my limit profit order as though it was a short trade, and I increased that distance down considerably, and the price was running. It was 3.5% against me. That's asymmetric loss. I went and got a cup of coffee, threw some wood on the wood stove, and came back, and price had come back down in about 6 minutes' time to a 2.5% loss. To make a long story short, in about 15 minutes after the price had gone 3.5% against me, I made 1.8% profit. So I went from an asymmetric loss of 3.5 to a 1.8% gain, which is, you know, it's not a small gain in relationship to the size, but you get what I'm saying. It's basically half, just about half of what the risk was. So if I was talking about risk to reward ratio, I'd be upside down. But the risk to reward doesn't mean anything, because what you're doing is you're going to say, I'm going to take a 1 risk to make a 3 profit. That isn't what this is about, because that metric doesn't make any sense. It's an invalid metric. If you have any questions about that, you're going to have to send me an email, and I'd be happy to chat with you about that. But I was willing to take an asymmetric loss for what could potentially have been a small gain, because I'm there and I'm watching the trade price action as it started to creep back down. And if that price would have staggered and held there, it's okay for it to go back up and then come back down and stutter a little bit, but there's a condition that I look for, and I would have hit the button and got out. And at that point, I was a 2% loss. Then it went to 1.5% loss. I said, this is going in the right direction. I don't even want to sit here and watch this. Because from a probabilistic standpoint and an asymmetric view, I saw that the probabilities, the way that I had foreseen them originally, were going to take place. And not only to get a small profit out of that bounce, but extending it down to about double what I had expected. Got another cup of coffee, went back in, and got the 1.8% return against my risk. And you say, yeah, but most of the time you do that, you're going to lose. No, because I don't do it most of the time. I don't do it a lot. I only do it under certain conditions. And those conditions, though they're not used for this particular type of trading, those same conditions and processes that I trade normally, I applied to that situation, although I added a condition to that. See, all my rules are condition-based. I have 3 rules for the trading. I call it the life cycle of a currency position, because that's what the position is. It's the life cycle of that currency position, going from entry analysis, position management, and exit methodology. That's a rip against my 33-year career as a software engineer, designing complex problems where we used what's called the software development life cycle, the SDLC, which is a process that software engineers use to solve complex problems. I just did a rip on that. Life cycle of a currency position, entry analysis, position management, exit methodology. And so what I teach in that is fine, except for when I'm going to do a probabilistic asymmetric upside down scenario, I add a condition to my rule. Actually, two conditions. One condition to the first rule and one condition to the position management rule. Same rules, same processes, just one more condition in two of the rules. I just have 3 rules for all of my trading. Each one of those rules has between 2 and 4 conditions. That's it. And I always use it. And I don't change the rules. However, because of the way that I put input into the rules, I can get a different conditional response based on the type of input that I put in. But that's how software engineers do their programming. When they're dealing in an object-oriented manner, their input to a particular object is done by like a command pattern or a proxy pattern or something. It looks at that input and goes, oh, this input means that he wants to do this, and then there's the logic that does that. You can put the same input in, but maybe at a little bit different. Like instead of saying my input is red, I'm going to say my input is burgundy or my input is pink. So that's the same rule and it's the same condition, but that condition then operates, oh, this time he wants burgundy color, this time he wants pink. And there's different ways that the rule then deals with that. I don't have to worry about that because the rule is programmed to do that, to return me a binary answer. Yep, you're okay in doing burgundy today, Peter. Or nope, you're not okay doing burgundy. It's really simple. It's simple because I'm a software engineer and I know how to do simple things. And that's what I teach in my fast track course. Most people don't believe it, so they argue with me when we talk on the phone. I say, you can argue all you want. I'm doing the trading. This stuff is mathematically sound from a probabilistic standpoint and from a realistic standpoint, because you can't just take a probability from an analysis and say, oh, that's what's going to happen, but you have to look at the realisticness of it. You could say, oh, it snowed out today and it's starting to melt and then it's going to freeze, but it should freeze. Well, that's a probabilistic estimate. I can't just go running out there on the ice because I may slip. It may not be that granular freezing. The snow covered is frosted, but it didn't turn to water and then freeze. That's what causes the black ice, as opposed to a granular surface that you don't slip on. It's slippery, but you wouldn't slip on it. And so these rules, when you're trying to deal with asymmetric results from your trading, they have to be condition-based so that the conditions recognize when you're going off on tilt and running an asymmetric process. Whether that asymmetric process is asymmetric wins, which I teach in the fast track program, or an asymmetric loss for a small gain, which I don't teach. Because someone who doesn't have the experience and the maturity in trading and can prove that shouldn't be trying that kind of shit. Look, Forex trading is 90% against you anyway, just from the get-go. And if you listen to these people out there talking about Bollinger Bands and Fibonacci's and trading the new Forex news and all this stuff, you're going to end up flatlined. I mean, you just are. I did when I first started after I listened to all this stuff for like 7 years. I studied the Forex market from 2007 until 2017, 10 years. I was doing it for academic purposes first, but for 4 years I traded in demo. I had a couple of mini accounts. I worked this stuff through and had the confidence in what I was doing because I was watching the videos. I was doing all this stuff that was being presented on the videos. And I took courses, and good courses too, expensive ones. And I thought I had it all locked down. I thought it had been explained to me so that it would work. The same way that when I would ask, I spent 40 years as a real estate investor. When I got started, if I had a question, I asked somebody, I'd get an answer, and that answer would work. I expected the same thing. Oh, I look at a video and, oh, that's the problem in my area. What's this guy doing? He's using a fucking Fibonacci number. Oh, okay. Oh, I'm not going to do that, but I get what he's trying to say. But I'm looking at the thing through his eyes, not my own. So I went in to the market confident that I was going to be able to make this thing work. And as I've said many times, I went in with $45,000, and within about 4 months, I lost $40,000 of that 45. And I said, what the hell was that? That's when I stepped back from things and looked at the market from a software engineering standpoint. It took me 15 minutes, because I'm trained to do that, to refocus. I've been looking at solving the wrong problems. And the problems that they were being presented to be solved stupidly. Well, I did degree in physics and math. The math doesn't lie. 1 + 1, it's 2. It's not going to change. The probabilities morph, but you have to understand how to manage the probabilities from a reasonable standpoint. You can't just flip a coin and say, I got a 50-50 shot. That's not the way you look at trading. That's not probability. And that's not how you write rules for that. So in 15 minutes, I said, okay, this has got to be something like the software development life cycle. I said, I'm going to call it the life cycle of a currency position. There's 3 rules that are going to dictate that: entry analysis, position management, exit methodology. Each rule solves one problem. If the problem is too complex for one rule to solve, then the problem's got to be broken into 2 pieces, so I get two rules. That's how you do it. So all I did was use those 3 rules against the remaining $5,000 in my account, and I just about doubled that. I came within $200 of doubling it in about 3.5 months. About the same time it took me to lose $40,000, I doubled my $5,000. And then I added $10,000 to the account and traded that for a while till I was sure everything was going to be okay. Then I added another $10,000, and then I added another $50,000. So now I was starting to build some stuff up. But I was only taking the risk management the way that the life cycle of a currency position that I had created laid out for me. And I was able to make 6 figures and multiple times. I mean, there were, I think 1 year I had 3 months where I made $30,000. A normal month might have been $8,000, $6,000 or $8,000. So I had 3 months where I made $30,000. Those were big gains. They were big hits because I knew how to make that work. And then I came to a point where I had advanced the number of lot sizes that I was trading too fast. I went from trading 1 to 3 lots to trading 25 to 30 lot positions in 7 months. It was just too fast. And so when I did an asymmetric risk for a normal gain, the risk took out all the profits. I lost 6 figures, multiple 6 figures. So yes, it can go against you. And I didn't realize at the time, I was too busy working the rules through and playing the game the way that I knew how to play it, to be able to, I didn't step back from it and look at it realistically again and say, whoa, wait a minute. There's certain metrics that you can look at that determine what we call the performance curves and all that stuff. And I didn't do that. I didn't look at it. And so I jumped into the deep end of the pool, and I wasn't ready to do that. However, that doesn't change the fact that you can take larger risks than the gain that you're looking for, as long as you have a better winning value in your win-to-loss ratio, that your average win value is solid enough, and that when it's time to take that big risk, you've built up enough profits or enough skill that if you lose, you can make that back in a shorter amount of time than it might take somebody else. I knocked out a 3% loss. Let's see. I did that, I think it was last month. In December, I had a 3% loss, and it took me 4 days to make that back. But that 3% is a big loss. It shouldn't have gone that far because the probabilities really weren't there. So we make mistakes. I made a mistake, and I took a 3% hit, and it didn't come back. And it went to 3.5. So I was a 3.5% risk loss. So I stepped back from it. The next day I went back in and started trading again, and it took me four days, but I made that back so that I was 0.1% up for the month. I ended the month up at 0.1%, where before I was up 9% for the month. Let me see, I was up more than that. I was up 11.5%, and I took a couple of big hits going down because I was trying to make the end of the year. But I made all that back. It's tough. It takes 3 or 4 days each time. And those are 3 or 4 days that if I would have been more conservative and not taking the asymmetric risk because it was inappropriate to do so, yeah, then I could have probably ended up at 8-12% gain on my risk for the month. But instead I turned it upside down and I only gained 0.1%. So when it goes badly against you and you try to make that money back, it's very difficult because you're losing track of things. That's what happened to me in December. I had the asymmetric loss a couple of times and I'd make it back, but I was forcing making it back and coming back. You know, I do a 2% loss because, and I was scalping at the time, making 2 or 3 pips at a time, and then I take a 2% loss. And I go, oh shit, now you know it's going to take me a couple of days to make that back. So I had a series of those at the end of December, and the volatility, and yeah, it's my fault. I should have just had a cup of coffee and not worried about whether I should take a big Forex risk for a small gain, because it wasn't time to do that, and my rules were screaming at me not to do it, and I didn't pay any attention to them. And that's what happens when you don't pay attention to your rules. Peter Rose, Longwood Currency Trading. Have a great day, and have a great trading day.